Hello, I'm Ben Jones and welcome once again to Dukascopy TV. Tomorrow, Australia will release its unemployment rate. Recently, we've seen business conditions there substantially drop, so joining me on the line to discuss these statistics and more is Sian Fenner from Oxford Economics. Sian, if we can talk initially about the business confidence and conditions figures that came out yesterday. Business confidence dropped from 9 to 7, but more surprisingly, we saw business conditions fall dramatically from 5 to 0. Can you explain the reasoning behind both of these figures?
I think actually what really needs to be highlighted from February's business survey is that firms actually are still quite hopeful of a recovery, and that's why we've only seen confidence sort of soften, if you like, but it's still remaining above trend. But this really isn't feeding through to real activity. In particular, if we look at what's happening for the manufacturing sector, conditions remain very sombre, and they continue to struggle despite the fall in the Aussie dollar over the past year. Now, this is really only 1 month, and indeed conditions are coming off a 3.5-year high, but it does really highlight the risk that the recovery in the non-mining sector isn't going to materialise as we or the RBA are projecting.
Now, over the weekend, we saw Chinese exports for February fall by over 18% compared to February of last year. How damaging can this be to Australia, especially if the figures continue to fall?
I think firstly what we need to take into account when we're thinking of the Chinese export figures is that there's really likely to be two negative distortionary effects in play here. The first one's the timing of the Chinese New Year, but there's also been the fact that there was fabricated trades last year. If we look at the Chinese New Year first, the impact, exporters are likely to have front-loaded February's exports to January, so that means that's why we got that boost in growth in January, but then it's going to be dented, of course, in February. Now, if we average that out, it means that exports did still decelerate on the year, but it's more of a neg 1.6 year-on-year versus that sort of very large 18 plus. Now, the second one is actually the impact of the false invoicing. Exporters last year were inflating their invoices to take advantage of tax credits and avoid strict capital controls. Now, this means that really until probably May, we're going to see export figures sort of be downwardly distorted. How much so, we're not 100% sure, but we are aware that this is going to be happening. So clearly, though, I mean, if it continues to fall, if it falls by more, we're seeing that actually in the national accounts, so the Australian trade figures, this will be quite a concern. What we'll be worrying about, it will have an impact on business confidence, but clearly Australia is also quite dependent on the Chinese economy as it's its largest trading partner. And our outlook is actually on the basis that exports to China remain very robust. We are seeing that in the data, but of course it would be a risk if it continued.
And finally, coming up tomorrow, we have employment data out for Australia. The unemployment rate has been creeping up over the past few months. What do you see happening here, and how damaging will a jump in the unemployment rate be?
Okay, we're actually looking for total employment to have risen modestly in February. The consensus is actually for a modest rise as well. This isn't going to see the unemployment rate fall, though, and I'm expecting it to continue to hover around the decade highs of 6%. Now, I mean, the increase in the unemployment rate is actually starting to it's showing up in confidence. We had consumer sentiment out today, and it actually fell to its lowest level since May 2013. And given weak wages and employment conditions, it's really not surprising that households are becoming more pessimistic about future finances, and that means that we should start seeing that weigh on spending in the coming months. We're also really not expecting labour market conditions to improve sharply in the near term. We're seeing that given that we've got the current weakness in business activity, but also federal and state governments are continuing to rein in their labour costs. This means household spending is likely to remain below trend this year, and it will definitely not be one of the drivers of growth that has been in the past, which again puts another sort of downward risk on our economic outlook, and means that it is very heavily reliant on a recovery in the housing market and stronger commodity exports.
That's all we have time for, I'm afraid. Sian, thank you very much for joining me. Stay tuned to Dukascopy TV, as Durham McDermott will be bringing you the second edition of forecasts for the week. Thanks for watching. Goodbye.